Queen's Court. I'm excited for this question that I have for you guys today. And I know that we've talked about it many times, but in recent conditions that we have had in the market, I think a lot of people have this question. I'm certainly getting it in emails and texts and stuff from our students. The question is, when is it time to think about protecting that long-term portfolio? And I know with trading, we can, obviously we trade bullish, we trade bearish, we trade neutral. So we have ways to, to make up for those bullish trades that, end up going against you, and we can trade bearish and make up for it in those ways. But, when you've got those long-term investments, like, me, my Bank of America financials are getting, butchered, right? Because of all the things that are going on with the financials. When is it time to start thinking about protecting your portfolio? We do enough with covered calls, just, selling covered calls and just, mitigating those losses there on the cash flow side of things. But when is it that you should really think about, okay, the flood is coming, the hurricane is coming, they've announced it in the news, it's, it's offshore, it's starting to come. Should I buy portfolio insurance? And if so, is this the time?
That is such a wonderful question.
It's such a big, important question, right?
It's a big topic too. There's a lot of ways to hedge, number one, right? A lot of ways to hedge. If your concern is in the short term, I feel the best way to hedge is to write calls against long-term positions and to add a couple few short-term bearish trades to offset some of the bullish delta. I think that's the easiest path to do when you're in like the reversal, for example. And right now we're in the reversal. And so I feel like, while you're in those reversals, and markets don't just go down, not even in the worst bearish downtrends do they just go down. And so when you're in the reversal analysis, I think it is much more appropriate to adjust the risk perspective by writing covered calls and adding put options. And the reason is because of the increase in volatility. When you look at the S&P 500 here, and let's go to SPY here, and I'll come to Bank of America here in just one second. But when I go to the S&P and let's take into account implied volatility here, right? Now, implied volatility is a measurement of basically implied volatility, or Vega as tied to the option Greeks. Well, as you can see, over the last couple of weeks, what's volatility been doing? It's going up, it's going up, it's going up, it's going up, it's going up. And so if you're making a decision today to buy insurance on your retirement account, you're paying premium. Mm-hmm. You're paying premium because you're buying healthcare insurance after you were just diagnosed with cancer. You're buying cell phone insurance after you threw your phone against a brick wall. You're buying life insurance after you just died. You're buying car insurance after you just wrecked your car. The premiums are ridiculous. And so it's much better to, in my estimation, sell those covered calls in this environment, because for the same reason it is very expensive to buy those put options to offset the risk, is the very reason you're collecting a little bit more cash flow on the sale of the call options. And thus you're basically receiving a higher premium, offsetting more of the risk. And so while you're in the reversal pattern, I feel like adjusting the delta through a short-term trading perspective, writing covered calls to adjust that delta to get more in line with where your market bias is, I think that is the preferred method for active traders. If this was Ma and Pa, if we were talking to Ma and Pa America, and they had done nothing but park money in a 401k over the last 12 years and achieved, financial greatness as compounding gains over the last 12 years. And they're investors who literally do not understand the market mechanic, they should buy insurance. They should absolutely buy insurance to offset the variables to the marketplace, because they're not able to catch those covered calls in the time. They're not able to catch the short, adding bear trades. And so I do feel like we are in an environment where prices and the uncertainty has enhanced towards it's very difficult to project where price is in 6 months from now. It's very difficult to project that. We could see a recovery. We could see a massive crisis. We just don't know. And so for those investors out there that are unaware of a lot of these variables and do not have the ability to sell covered calls to bring in that cash flow to offset the volatility increases, or do not have the ability to add short-term bearish trades to to adjust their delta quite radically against the market bias. Yeah, I do think that the variables and the wall of worry is sufficiently enough to say, you know what, there's a bunch of dark clouds on the horizon. Those dark clouds certainly could add up into a massive storm, and that could have a massive impact on price. You don't want to mess with the things that you have achieved over the last 12 years. You don't want to play with that fire. And so for investors who are more on the passive side, adding a little bit of insurance, even if it's out of the money, put options to offset some of that risk, that certainly does make some sense. And so to give you an example of what I'm talking about, when we're looking at, say, a retirement account, and I simulate kind of the S&P 500 here. So, and I'm going to make this simple. Okay. So we're going to own 100 shares of the S&P at the current price, 424. What I'm doing is I'm basically simulating a IRA, a 401k, a retirement account, because whatever your retirement account is in, whether it's mutual funds, ETFs, market index funds, or stock, the S&P reflects that. And so what we're doing is just kind of putting together a portfolio that reflects about $42,000 in a retirement account. That's all we're doing. Well, when you look at a risk graph, and this is where the decisions really are made, when you look at a risk graph, if your concern is to the downside, and if we see another 10% downward movement in price from the current price of 424 all the way down to about 384, you're going to lose about 10% of your retirement account. And that's with the 10% bump, and a 10% bump in the S&P in this condition could be 2 trading days. Yep. Like legitimately, it could be 2 trading days. And so it's, if you're not active and you're on the passive side, yeah, I do think you can go out to the market. It's a little bit volatile. You're dealing with the S&P at a volatility of 35, 33, 34, 32. That's higher than it normally is. We're talking about the broad market here. We're not talking about, a covered call we'd like to get 3% cash flow on. And so when you're looking at this, yeah, you could go out a little bit more time and say my mom, who's, retired, she funds her retirement through, investments in real estate, in the market. And certainly she's called us a few times asking about her Bitcoin. I keep reminding her Bitcoin's the people's currency, not just hers, but she doesn't understand that. So, if my mother's sitting here calling me and it's somebody that I know is not active in the market, that they're parking money in the market, and they've done a lot of great things over the last 10, 12 years, and they're nearing the age of retirement, and they've done enough in their life to retire with some degree of, stability and the ability to maintain their lifestyle throughout their retirement. I don't think you mess with these moments in time. I don't think you mess with the thing that's going to fund your entire lifestyle throughout your retirement. And so, you can come to the market and say, okay, I just want to lock it down. I'm willing to take a little bit of risk, but I just want to lock it down. And so they can come out to the market 465 days from now and say, okay, I'm willing to spend the 10% of the money I was going to lose on a 10% drop. Boom. By a put option. And I'm showing aggressive insurance because it's not the money. I'm just showing it. Because of the 10%, you would have lost $4,000 on the 10% downward movement in price. Well, I'm going to take that loss that they were going to have with the downward movement in price, and I'm just going to allocate on a put option. And when you do that, look what happens to your risk graph here. And for people out there watching this report, they might be like, oh, it's a cost. I don't want to pay $4,000 in insurance. Really? You want to lose half of your retirement account?
Okay. We'll insure ourselves.
Well, and also, it's not a cost. It's an allocation against an asset class. That's what it is, right? You're allocating a portion of your retirement account to insurance. And I want people out there who are new to tackle trading to understand this insurance philosophy very much. it's amazing to me that they come to the market and when they learn about insurance, I'm talking about new traders, they're like, I would never pay 10% premium to protect against an uncertainty. And then I ask them how much they spend on their iPhone, and it was $1,000. And over the next year, they're going to spend 17% of that $1,000 to protect against an iPhone, of which is not nearly important as your retirement account. And then I asked them how much they're paying on the car insurance and premium against the value of the car, and they're paying that there. And then I asked them about their house insurance against their mortgage, and they're paying that there. And then I asked them, hey, do you want to, and then I asked them about their life insurance. They say, yeah, I pay a premium on our life insurance. And I'm always like, well, do you want to die so you can get your insurance? No, like you gotta think about this the same way you think about any form of insurance in America. And so without the insurance, if we did see a market crisis that truly did see those repeat of the subprime meltdown, that we saw a repeat of the .com, or maybe even the quick volatility to the downside that we saw in the pandemic, without insurance, well, you just see that loss expand and expand and expand and expand. And let's say we get the market to cut in half here. Well, you're going to lose half of what you have in your retirement account. Well, if I add the insurance, all of a sudden I've cut that away. What you have to think about the insurance is it's not about the cost of the $4,000 to protect the $42,000. It's you're allocating 10% of your resources into an insurance position. And you basically, what you end up doing is, look, if the market goes up to 465, you're going to make $4,000. If the market crashes, you're going to lose 20 grand. Okay. Mm-hmm. And again, I'm just painting a scenario of hypothetical. I'm not suggesting that the market's crashing. I mean, go look at the first 30 minutes of the report and you'll see my thoughts technically. I'm just kind of explaining the process for the new tackle traders out there. And so when you're looking at this, think about it as allocation. And number two, look at it from a reward to risk ratio perspective. If the market continues to show price appreciation and we see a repeat of 10% back up into the all-time highs, we're going to make $4,000 in that environment. Well, if the market does crash, you're going to lose $19,700. Well, you add that insurance. And again, it's not 1 month of insurance. It's a 420 put option that expires in June of 2023. That covers all the monetary nonsense over the next year and a half. That covers all the geopolitical nonsense, that covers all the inflationary scale, and you can legitimately not care about your retirement account for the next year and a half. So the question is, would you rather do that? Well, look at it from reward to risk ratio. I'm giving up a little bit of my gains. I'm giving up a little bit of my gains. But what am I also doing? Mm-hmm. I'm cutting out 75% of the risk. That is an option. Well, another option, if you don't want to be that aggressive, you can go and kind of say, I'm willing to take a little bit of downward movement in price, and I'm going to go all the way down, and I'm going to buy that 25 delta contract. So instead of, buying that at the money contract for, $4,500, which has just went up, you can go down and say, I'm just a little bit worried about the market, right? And I'm going to go buy that 25 delta contract, because this is a beautiful thing about the United States marketplace. You can choose what you want. You can choose whatever your little heart desires. And so you look at that right there, you're cutting the cost down in half by on the insurance. You come to the risk profile. You see the same risk profile here. What's the difference? We're going to make a little bit more if it goes up, and we're going to lose a little bit more if it goes down. And so there's ways that you can create something that you are comfortable with from an insurance perspective. Does that make sense? But with your Bank of America as an active trader, Emily, as an active investor, you come to Bank of America and you can do the same thing. You can do the exact same thing. Let's say you own 100 shares of Bank of America, right? You look at the risk graph, you got the risk profile like that. You can say, let me come to the options market and go out all to next year, and I can go buy that at the money put option, and I can rock that, and I can control that risk graph a heck of a lot more. My point is, there are a lot of different ways to offset risk as an active trader, Emily, and you certainly know that. But the whole point is, I now can come to the market. I can sell a 43. I'll even go do the 37 delta contract. I can come to the 37 delta contract, and I can bring myself in $2.70 of cash flow, I can take advantage of the volatility by bringing in the 270 cash flow. I'm offsetting 8% of the risk already. And if I do it next month and the month after that, the month after that, the month after that, even if Bank of America, which is extremely volatile right now, continues to go down, you as the active investor won't have to pay anything because you're offsetting that risk through the covered call, through the covered call, through the covered call, through the covered call, and you take advantage of that volatility, if that makes sense. So I hope that was a detailed enough answer for you. Mark, do you have thoughts?
More than.
I mean, nothing from the detailed perspective, but big picture. And I love what Matt said about active traders having so many more tools than the passive investor who's like, I'm scared. What do I do? I mean, active traders can do so much through tricks and techniques. I was talking to a trader in the Traders Lounge this morning who had Roblox. Pull up Roblox if you remember. An 85 naked put that their cost basis had gotten down to $50.
Wait a second, hold on. Let me. So they bought at 80.
85.
85. They had sold the naked put at 85.
Okay. For a long time, been managing this position.
Got smacked in the face, right? Because they got smacked in the face on that 85 put. I promise you, that was volatile and that came down fast. So I'm sure they took a loss initially pretty heavily on the put, correct?
Yeah, well, like I think they've had this position actively trading for a while, but they said
all I'm saying is this. They were put at 85. What's their cost basis?
50.
I just think that's so impressive. I just think that is so impressive.
I was like, well done.
It's not the fact that they were able to offset 85 to 50 in such a short time. It's the fact they did what they were expected to do and they did it without thought. Because if they had to think, they didn't do anything. That was awesome. I don't even know who it was. That was awesome management, beautiful management.
So I have two main thoughts here. One, active traders have, and the power of cash flow. Like, my accounts are over the last couple months treading water, right? There's been so much damage on individual accounts and this and that. I can't even imagine like the inability, like if I wasn't an actively and new tricks and this and that, the damage would be so much more severe, and so active traders have so many more tools. But big picture, like, nobody likes insurance, right? I don't like paying insurance on my house.
I don't like it either.
Nobody likes it. But the plain and simple fact is you cannot have a level of hubris in your long-term investing, if you are a passive or even an active trader, to say, well, everything's just going to always work out no matter what at all times. It's your financial future. I remember having a college professor when I was doing my graduate work who had to work, and I was doing my graduate work during the financial crisis, and he had to work for several more years because of the damage done in the financial crisis to his portfolio. And I'll never forget because he was such a good human being, and generally you could just tell it was just like right, like just those deflating, like your future's too important to just have this cavalier, like the retail trading period from 2020 where like stocks just go up. And listen, I believe in the upward gravity of stock markets, right? I don't think we've seen the all-time high in the S&P, right?
Can I jump in real quick on that point? I agree. I don't think we've seen the all-time high in the S&P. I agree 100%. I do believe there are stocks in the growth area of the market that we have seen their all-time highs.
Oh, yes, absolutely, 100%.
The same way we saw their all-time highs in the 2000. Even quality stocks never achieved back. Look at Japan 30 years ago.
Point in the Traders Lounge this morning that I think, like, listen, like you need to reset your expectations if you think space is going to hit $60 again, right?
Yeah.
They'll
hit $60 again if they have revenue to justify $60, but it isn't going to hype it up there again.
I'm not saying one day ever, but that time period in the market.
Do you agree with this, Chucky? This point? The initial time a stock surges like space and it goes to 60, it just takes on a life of its own, correct?
Yeah, right.
For it to do it again, it's got to be based on something besides hype.
Yeah, no. you're not going to see what you saw in 2020 and the first part of 2021. You're probably not going to see that for a generation again. It will happen again, right? Because there will be a situation,
and there will always be pockets of it, right?
Yeah, and there will always be pockets of it, right? There will always be a company that just goes parabolic.
Energy right now, gold stocks right now. Go look at solar positions right now.
Yeah,
solar, and that's something to keep an eye on. Solar companies right now. Word coming out of Europe is they want to become clean tech and not relying on Russian energy products. Now, right now, they have to do it in the future. Remember, in the future. And so, yeah, there's always going to be pockets of it, right? But it doesn't mean the entire market does it.
But yeah, you just can't have the hubris to say, well, especially the shorter the time window you have to retirement, right? Like if I'm 25 and I'm building a portfolio, am I as worried about insurance? Probably not.
But you should, because it's always the right time to do the right thing. And if you act like a cavalier investor at 25, you're not going to have that decision ability at 45 because you risked it all in your young 20s. I'm sorry, you don't know how long you're living. You need to build a legacy from the time of 25 to 65. That's just my mentality. Not everybody embraces it, but I did say it, so I'm gonna own it.
Like markets can go through rough stretches, and when you look like tactically, I actually am like bullish maybe for tactically, and we'll use that stretch to. But whenever you have a macro backdrop that is particularly challenging, I don't think you can just be cavalier that it's all going to work out in the short term right away. It's a very challenging environment, right? It's a very challenging environment, and I think we treat it as such. And boy, that gave that up fast, right? So Emily, as far
it's the cycle, give it an hour, let the wind change.
So as far as like long term, Emily, like as far as portfolio protection, active traders have so many more tools, but you can't just whether you're passive or active. And Matt did such a great job breaking it down. Just to say, I'm not going to do anything and I'm just going to sit. Well, ask how many traders on individual stocks over the last 4 months, how that worked out for them, right? Like, and from a broad market perspective, you should always have defense in your mind. I don't think that's ever a bad idea.
Well, on the cover call, last thought for me, on the cover call, when in doubt, right?
Yep.